Geopolitics and Policy, Metal Markets in 2026. 2 years ago, I gave a paper in Jakarta titled Critical Minerals, the Emerging Importance of Security of Supply. It painted a picture of commodity markets being driven by a new era of strategic competition. At the time, this was considered by some as somewhere between fringe geopolitics and heresy. Today, it's the operating environment for the metal sector. This presentation covers the new geopolitical backdrop, Indonesia as a case study, the outlook for copper, and gold's re-emerging role in finance. China's dominance in battery metals and clean tech isn't ideological, it's operational. They control scale, process knowledge, and choke points. In battery materials and refining, China doesn't just produce, it sets marginal economics. For traders, this matters because concentration increases tail risk increases volatility increases optional value. The Western response, IRA, CBAM, export controls, subsidies, is not about efficiency, it's about strategic redundancy, and redundancy is expensive. That cost shows up as regional price differentials, policy-driven arbitrage, and basis risk between clean, friendly, and non-aligned supply. We're not de-globalizing, we're re-regionalizing. Metals are starting to look like oil in the 1970s, not just commodities, but strategic infrastructure. Critical minerals are not universal, they're context-specific. What's critical to the US is not what's critical to China or to Europe. For traders, this fragmentation matters because it breaks global benchmarks, increases compliance complexity, creates parallel markets for the same molecule or metal. The price isn't just about supply and demand anymore, it's about who is allowed to sell to whom and through which channels. Indonesia is a great case study on geopolitics, economic nationalism, and strategic investment. And it shows the roots of today's operating environment stretch back to the GFC. In 2009, Indonesia replaced contracts of work with a mining business license system which separated exploration and exploitation, mandated that IUPs must process their ore domestically, and mandated foreign investor divestment. Implementation was messy, and ore bans and relaxations occurred against the backdrop of a volatile current account and fragile investor confidence. We all know how the story plays out. Massive capacity build-out of RKEFs, H-Powers, MAC converters, refineries, together with accompanying infrastructure like roads, ports, and power plants. Today, Indonesia produces more than 2 million tons of nickel, 65% of the global primary units in form of intermediates, refined products, and stainless steel, but 80% of that capacity is controlled by Chinese companies. Timing and luck played a big role. There was a once-in-a-generation demand shock from batteries, very high geological concentration, ultra-cheap, captive coal power. Strip out any one of those and the model doesn't work. Many African countries now see Indonesia as the playbook, but this is not replicable in all metals and all jurisdictions. For traders and investors, this tells you where the false analogies will be made, and false analogies are where mispricings come from. Nickel prices are characterized by long, flat periods punctuated by violent flare-ups. This is unlikely to change. Indonesia now overwhelms the cost curve, but concentration creates fragility. Any disruption, policy, labor, ESG, geopolitics will transmit instantly into price. Indonesia is now the OPEC of nickel, not because it cuts supply, but because policy optionality sits in Jakarta, and to some extent Beijing. For traders, the key point is not whether policy is good or bad, it's that policy is active and therefore tradable. Aluminium could follow a similar path to nickel with similarities in geology and smelting economics, and increasing dependency on jurisdictions like Indonesia and Guinea. Copper is a very different type of metal with different geology and cost curve shape. 80-90% of the value of copper is captured at the concentration stage, not smelting. Copper smelting is low margin, capital intensive, and has been chronically oversupplied for decades, which shows up in TCRCs. Mandatory copper smelting in Indonesia was effectively a tax on copper mining, paid upfront in capex. It crushed the incentives for companies to explore and develop copper mines, which at the global level compounds the problem of too many smelters and not enough mines. Copper demand has become increasingly glamorized by stories of data centers, AI, EVs, and robotics. However, most analysts converge on long-term growth rates of around 2%. That is still a lot of copper to find, and the supply side is increasingly fragile. We know finds are smaller, deeper, and lower grade, but there are world-class undeveloped deposits out there, such as Pebble and Resolution in the US, Tampakan in Philippines, and Reko Diq in Pakistan. All have been blocked or held up by permitting and lawfare. Overfocus on smelting by governments in LATAM, Africa, as well as the West, will cause further delays and capital misallocation. Given the increasingly tight baseline, we expect prices to remain at structurally high levels, supply shocks to cause outsized price responses, and more dislocations and protectionism. Gold is not just a commodity, it's financial infrastructure. Unlike copper or nickel, gold is an inventory-driven market. Stocks are around 200,000 tons, whilst annual demand is 5 to 6,000. What's changed is not supply, it's who wants to hold it and why. Central banks are diversifying reserves, sanctions risk is real, and alternative payment rails are emerging. When countries reduce holdings of US treasuries and add gold, this isn't a trade, it's a plumbing decision. There are obviously some causation problems with the chart on the right, but I think the signal is valid. The gold is no longer just about rates and geopolitical shocks, it's about trust in settlement systems and a changing world order. We've seen a similar increase in the price of silver, now more than $100. Future currencies or tokens are likely to be backed by a basket of assets such as bonds, land, and precious metals. Speculative silver buying is a bet that this is part of the basket of assets. Notwithstanding potential for silver prices to make some very large swings upwards and downwards, I have less confidence in the financial infrastructure story for silver than I do for gold, but still not bearish. Here are my top uncertainty calls for 2026. Iran, trouble in the Middle East. The USS Abraham Lincoln aircraft carrier strike group is headed for the Middle East. There is a non-zero chance that something happens in Iran and affects oil flowing through the Strait of Hormuz, as well as the region more broadly. Upside in iron ore. With so much excitement in base, battery, and precious metals, iron ore has received little attention, and I feel like it could surprise us in some way. Demand in South and Southeast Asia may surprise us on the upside, whilst the last major investment cycle was a decade ago. Moat for the majors. Permitting difficulties, unpredictable policy, and lawfare continue to extend the lead times of mining projects, making it difficult to impossible for project developers in many jurisdictions. This is a good long-term case for the global diversified miners. Juniors as a policy call options. As geology and economics become a much smaller component of success, the junior space becomes more difficult. I place bets on companies that could benefit from positive policy shocks in jurisdictions like the USA, Argentina, and Saudi Arabia. Chasing margin. The gold story has not changed, but anchoring price to anything solid is tough. At US $5,000, I'm not selling, but I'm not buying much more either. Equities have finally responded, but still feel like a better deal. Most large gold miners have all-in sustaining costs between $1,500 and $1,900 an ounce. So even with a substantial drop in price, they should be printing money. Thanks for listening.
Market moves, I know the signs, nickel dreams and copper lines, spotlight shining on the ore, steel's got rhythm, I want